I want to focus today on something called a refurbishment buy-to-let. It's not new. They've been around for a number of years, but they've been ebbing and flowing. And I've just seen actually this week, one particular lender that offers this type of product has just refreshed it, revamped it, updated the rules. So I thought, actually, yeah, this could really appeal to quite a number of our landlords. So who does it appeal to? How does it work? Well, it's really suited to you guys who are wanting to buy a property that is not lettable at the point of purchase. Hopefully you understand what that means, but let me just explain for those that don't. That means at the point that you get the keys to the property that you're buying it, if at that point you would have to do some significant work to get it lettable. I don't mean cosmetics. I don't mean a bit of painting or maybe a change of carpets. I'm talking about maybe the kitchen isn't even there, or the bathroom it doesn't even function, or maybe there's a hole in the roof. It's something significant that says you just can't let it without doing some work to it. Well, that's a non-lettable property. So you're not going to get the traditional buy-to-let mortgage. So you have to look to bridging traditionally. Now, the thing about this refurbishment buy-to-let is that even though it's what I call a two-step strategy, it's a two-step approach. There's going to be bridging for the purchase, and then when you've done the work, you're going to exit into a longer-term buy-to-let mortgage. But the real appealing thing about this is that it's all under one roof. It's one application. It's one lender. It's one underwriter. It's one surveyor who's going to go out and value it as it is, as you're purchasing it. You're going to give that valuer a schedule of works to say, right, this is what I intend to do to it, to add value, to improve it. And then you're also going to say, and this is what I think it's going to be worth afterwards. So you're going to buy it for 100 grand. You're going to do 20 grand's worth of work to it. And you think, right, it's going to be worth 150. You've done your homework. Well, you give all that information to the lender, and that valuer will hopefully agree with you. So that valuer comes to the house, says, yep, okay, you're buying it for 100. Yeah, I think it's worth 100. I can see you putting 20 grand's worth of work in it. And yet I can see that that would give a market value post refurb of 150. So if they agree with your numbers, the lender will issue two mortgage offers simultaneously. So you have the mortgage offer on the bridging part, so you know you can purchase it. And at the same time, you've got a second mortgage offer so that when the work's done, you know you can exit onto a long-term bridge. So now, as a landlord, you've got complete certainty and all your ducks lined up throughout the whole process. And that's peace of mind, of course, for everyone. So some key points. Bridging. The interest is rolled up. If you don't understand what that means, it means you're not servicing the debt once you've got the bridging. You are not paying a monthly payment. So right now, once you've got the property and it's got a hole in the roof, it needs a new kitchen fit, and you've got no rent coming in. So you don't want to be paying any mortgage payments. So the lender says, I get that. So let's just park those payments, put them to one side. And when you pay us back the capital, we'll also say, but you've had this bridging finance for 6 months. So the interest payments for 6 months equates to 3,000 quid. You borrowed 75,000. So you need to pay us back 75 grand plus the 3,000. Maybe there's an arrangement fee, usually is. So then you pay that as a lump sum back at that point when you're exiting onto your long-term mortgage. So cash flow, brilliant. Rates, really good, starting at 0.55% per month. Again, for those of you who are not used to that, what 0.55, what does that mean? Well, if you converted that to an annual interest rate, you'd probably be saying, well, it's about a 7% interest rate. And you might go, oh, that's a little bit high. Well, first of all, it's bridging. It is a slightly higher risk. But the second thing is, you ain't going to have it for a year. As you can see on my next to last bullet point, it's up to 6 months. So you're going to be paying it off in maybe 2 months, maybe 3 months, maybe 4 months. So you're not paying 7% for a whole year. You're paying it for a fraction of the year. And as it says here, you can borrow up to 75% loan to value. So that's the bridging part. Once that's all done, then you're going to be exiting out the bridging and moving it onto a long-term mortgage. And as it says here, rates are starting from 5.59. Not too bad, sort of middle of the road. You can possibly get lower rates, but not when you're coming from a property that's non-lettable. It gets really sort of messy. But here's the thing: you can get up to 80% loan to value. So what many landlords like to do when they get in these properties that you're going to be adding value to is, can I ultimately pull all my money back out? So the cash that I put in for the deposit, the cash that I put in for the refurb, once I've added the value, if I can then pull all that money out, and if I can potentially get an 80% loan to value on that higher value, there's a really, really good chance that you can get all of your money back out. So it ultimately becomes a no money down deal. And how many of those do you want to do? Probably as many as you can get your hands on. Couple of caveats here. These are suitable for buy-to-lets and HMOs. So if you're thinking, oh, my SA, my holiday let mortgage, would that be suitable? Not on this particular product. Look, you can still buy non-lettable products with non-lettable holiday lets, but we have to split this two-step strategy across two separate lenders. So yes, you can still do it, but it's a little bit more involved because you're not dealing with one lender. So today it's just about you buy-to-let guys, you HMO guys. And as I said at the start, it's the convenience is that everything is done at the same time. There's consistency in terms of the same valuer who understands exactly what you're doing, same underwriter. And so it tends to be a lot smoother. If any of that resonated with you guys, if it's something that you think, yeah, actually, I'm thinking of buying a property that I know is not going to be lettable, or even if you're unsure, is it lettable, is it not, then maybe we can help. We've got a lot of expertise in-house to maybe look at the photographs, the pictures, send us a link. We're not surveyors, so you've got to bear that in mind, but it might be we'll be able to say, yeah, that's definitely not lettable, and we need to go down this particular avenue. So there'll be a link at the end of this piece to our diary. Click on there, cut and paste, jump on, have a word with the team, and we'll be delighted to help you in this regard.